What's up, my money movers? It is so great to see you again. Welcome back to the Do Different Better show. I'm your host, Elaine Rasmussen, CEO of Social Impact Now and founding director of the Connect Up Institute, as well as managing partner for the Integrated Capital Fund. Thank you for joining me today. Today, I was thinking about there's so many things that we've been talking about, and I was like, have we really talked about the types of capital that are out there? And I was going through all of the episodes and I was like, we haven't. And I probably should have started that a long time ago. That probably should have been my second episode, but that's okay. We're going to catch up. I'm going to break down for you today the three different types of capital. If you're a business, and how do you get ready for any of those types of capital? And we'll just kind of really talk about all the intricacies, because there really is only three types of capital, but you may have heard a whole bunch of different kinds of names for them. But we're going to get into that all today, and we're going to break it all down in really easy to understand terms. So we're going to talk about the types of capital, we're going to talk about the process of getting capital, and we're going to talk about how to prepare for getting that capital. Those are what we're going to cover today. So buckle up, Buttercup. We're going to have a great time. This is really meant to be sort of this really, I think even some experts don't even know, like, this is really the breakdown of how we think about capital. Now, once again, we're talking about capital. We're not talking about money, right? Money is just cash that you're using and how you live your daily life. We talk about capital. This is really what we're talking about, moving money in a very organized way, or through what's called a financial instrument, right? Which is through some kind of organization, whether it be a bank or some other kind of financial organization. But we're going to get into all of that. So first, we're going to just start with the basics. We're going to start with talking about what are the three different types of capital. Once again, there are only three types of capital. Everything else is pretty much a derivative of one of these three things. The first is cash. And you may have heard the expression, cash is king, cash is king, cash is king. Okay, I think that's true in a lot of different situations, but sometimes it's not. And we're going to talk a little bit about that, right? The next is debt, right? And you may hear it as a loan or owing somebody some money. That is debt. Okay. Then there's equity. And we're going to talk about all three of these in a lot of detail, but three kinds of capital: cash, debt, and equity. Okay. So first, let's talk about cash. Cash is something that typically doesn't need to be repaid, right? You either earn it and you have it, right? So maybe you work or you sell something, but you have cash. It does not need to be repaid at all. This is the category of this particular capital type. It has little or no ongoing obligation to you, right? And we're going to talk about this much more in the context of a business, just to kind of give you a frame of reference. We'll be talking about through the lens of business. So what are the different kinds of cash? Well, there's sales. And that to me is one of the most underestimated types of cash in a business, is actually their sales. People usually skip over that. Your sales are part of your cash. You make something, you deliver a service, somebody pays you, you now have this cash. Or if you've done the service and you're waiting to be paid, that is cash that you will have coming into the business. Then there might be donations. Somebody might just give you some money. Maybe it's an aunt who says, I really believe in you. I really want this business to get up and going. And they're going to give you, they give you a donation. They're like, hey, you don't have to pay this money back. I really want to support you. Then there are grants, right? Grants are actual formal ways of getting money through some type of organization, right? That grants and donations are not the same. Donations usually come from an individual, right? Maybe it's a friend, maybe it's a customer who believes in you and wants you to grow, but a donation typically will come from an individual. A grant will typically come from an organization. Maybe it's a foundation, maybe it's, Coca-Cola is doing a grant program to give small businesses, small businesses to be able to buy equipment. Maybe you've been the recipient of, or your child has been recipient of a grant for a camping program, or you've received a grant that to support the Girl Scouts or something like that. But those are usually given through a formal organization. Then there's friends and family, and then there's also crowd raising. And I'm going to get into each one of these in a lot more detail. So first, let's talk about sales. Sales are the best way to generate capital for a business. The time you spend generating sales, especially for volume sales, it's going to be tremendous. That's how you hear sometimes with accounting practices or accountants, they say, hey, we want to know how much cash you have on hand. That means how many months can you go based on the cash you have in the bank to keep your business going in case of a downturn. It is imperative to have projections that give you some best guess on the pace and scale of sales that give you an indication of the scope and scale of the profits that you are going to be making so you can prioritize where you want to deploy your capital to grow your business. Next, we're going to talk more about donations and grants. Donations usually come from individuals who want to support your business. And more importantly, they actually want to support you. Grants are given by an institution like a foundation, a neighborhood association, a state or federal government entity, or a municipality. These tend to be highly competitive and have restrictions for qualifying. So I would proceed with caution, as these can also take a lot of time without a lot of reward. Sometimes when I'm talking to businesses and they'll say to me, hey, Elaine, do you know where I can find some grants? And I'm like, no, but I can tell you where to find a customer. Right? Because a lot of these grants, especially when you're talking about a national organization, let's say it's a corporation that wants to give out grants to small businesses, you're competing with every single business across the country. So unless the grant application is very easy, and sometimes they're not, sometimes they're very involved. But if you think that you can fill it out within an hour or two, I say go for it. But if it's an application that takes a lot more time and energy and you don't have the time, especially I would say take the time that you have and go and find a customer. That is going to be your best bet. Then you can get donations from friends and family, or there's what's called friends and family capital. You may have heard this term. Hey, I got some friends and family money, or an investor might tell you, go and get some friends and family money. Typically, friends and family give you money with little or no obligation for repayment, or at least very flexible, friendly repayment terms. The capital can be used for hiring, making prototypes, marketing, or whatever you need at the time. It's really an excellent way to get investment without having to put your money on the line. And it may be hard to believe, but I've known many businesses that have gotten friends and family money from customers. Your customers, your early customers, they want you to succeed. And so sometimes they might give you a friends and family investment, once again, with no obligation to repay it. Maybe you have to give them a discount for, the life of the business. Or maybe you're going to give them a free service, once a month, every month. Whatever it is, you can work out an exchange for them giving you friends and family money. Plus, friends and family capital often comes with less strings than traditional loans or other investments. It's not uncommon for customers to be part of friends and family capital. So now that we've kind of covered the various opportunities within cash, now we're going to go into the various types of debt, right? So we just talked about cash. Now we're going to talk about debt. And there are several kinds of debt. And I don't think sometimes people even think about it in this way. But credit cards are debt. Lines of credit are debt. Loans, maybe it's your home loan, maybe it's a car loan, that is a debt instrument. There are what's called convertible notes, and we'll talk a little bit about that. There's royalty financing, which is also a form of debt. There's also purchase order financing. There are lots of different names of the structures of what kind of debt you can get, whether it be as a business or as an individual. But once again, we're talking mostly about businesses, but they are all at the base of it, they are structured for money going out and being paid back at a certain amount of time, for a certain amount of interest, for a certain amount of penalty. right? So let's first talk about credit cards. And people usually don't think about credit cards as loans or debt, but that's exactly what they are. Credit cards are useful for short term bridge capital, but it can be tricky to manage for long term sustainability. And that can be high interest rates and compounding interest rates that can bury a small business. So you really want to be mindful. Right now, credit cards are creeping up to 30% interest. That means for every dollar you spend, you've got to pay an additional 30% interest if you go beyond the 30-day period that the money is being lent to you, because it is a loan. They are loaning you money for a short period of time, and they are anticipating being paid back at a certain period of time. And if you do not pay that, that is when interest starts to accrue, and the interest is very expensive. So credit cards are basically loans. They're very short-term loans, right? So then there are lines of credit. Line of credit is exactly what it sounds like. It's capital that sits at a financial institution, more than likely a bank, until you actually need it. That means you've gone through the entire process to get the money. You can draw on this money as you need it and then pay it back after you paid back the amount that you've used. You can continue to borrow up to a predetermined credit limit. It's ideal for someone who needs access to money quickly or expects their cash flow to fluctuate in the short term. This type of loan actually carries relatively low interest rate compared to an unsecured credit card debt, right? But it is meant to be short term. So oftentimes a line of credit might be 3 months to 3 years. It will require a credit check and or some kind of due diligence. And I'll talk about due diligence in the next segment. It also could help with like purchase orders or reimbursement. So oftentimes if you have a government contract, you have to expend the money and then request to be reimbursed. So there could be a 90-day period by the time that you are sending your invoices to fulfill a government contract and when you actually get paid by the government or municipality. This also can happen when you're working with retail vendors. So let's say you're a lemonade producer and you're selling to a big box store. You may not get paid for 90 to 100 days, but once you've delivered the product, you paid for the money to make the product, and now you need to wait until they actually pay you, which could be 90 to 100 days before you get the check for the money you already expended. So a line of credit to make sure you're able to pay your bills, you're able to pay your employees, is a great opportunity for you to be able to do that. And without losing a lot of cash you can borrow against. So here's the wonderful thing about lines of credit. First of all, you're only going to pay back. You let's say you get a line of credit for $100,000. You do not have to borrow the $100,000. Let's say you get into a situation where you are going to deliver a product to a retailer. You're going to have to wait 60 to 90 days to get paid back. That could put you in a cash crunch. So out of that $100,000, you only need to borrow $20,000. So you borrow the $20,000, you make sure you can run payroll, you get paid back, you get paid for the invoice that you sent to that retail customer. Now, what you have the option of doing is paying back the $20,000, or if it makes more sense for you to keep it as a loan and pay it down incrementally, you can do that. But you're not repaying the $100,000. You're only repaying the $20,000 because that's the only amount that you borrowed. But what the bank has said is you are qualified to borrow up to $100,000 in case you need it. So let's say you needed to put a down payment on a piece of property that you're getting ready to buy. The line of credit would allow you to be able to do that. Typically, it's only businesses that get lines of credit, but an individual could get a line of credit based on their business activity. They could get a personal line of credit based on their personal business activity and their personal income. So, but typically lines of credit are typically afforded to businesses or other types of organizations. So the next thing we're going to talk about are traditional loans, right? That's most what you commonly hear about. There are lots of alternative lenders that provide loans. So there could be community development financial institution. We've talked about this on the show. Those are what are called CDFIs. They are usually set up for a specific purpose, for a specific geography, and or maybe a specific industry to be able to borrow to lend flexible terms and more favorable terms to small businesses, to sector businesses, or to a geography that maybe have some economic um, issues. But there's also credit unions that give out loans. There's also some new players that are coming onto the field that are providing loans. And those are what are called vendor lenders. Those are like Square, PayPal, where I think Venmo is getting at like, hey, we know that you're a masseuse and that you might need to borrow some money because maybe you have a corporate client that didn't pay you on time. So you may need to borrow money. So these are these vendor lenders. They're vendors who are also providing you an opportunity to borrow money. Now, what happens with those things is you have to be careful about some of those deals. A lot of times they have fluctuating interest rates. You really want to be clear about the terms, about if you're going to be working with a vendor lender. Another institution that provides loans are banks. And there are also foundations that provide low interest loans to businesses. These are called program related investments. They're not something I highly recommend because you really have to have a strong network to be able to break through to get a PRI. But if that is something that's afforded to you, you have really, maybe you came out of the philanthropy sector, you came out of the nonprofit sector, and you have you have relationships in those foundations with their investment committees to be considered for a program related investment, great. But the reason why I say these aren't necessarily the best first place to start for a business is there is a long cycle. There's a long due diligence cycle. And if you are looking for money right away, an alternative lender, a bank, or a vendor lender might be a better situation for you. Next, I want to talk about convertible notes. So convertible notes are an investment tool that's used to bridge the gap between a seed round of getting investors and a Series A round of getting investments. They are a type of debt that can be converted to equity at a later date, allowing investors to receive a return while having the potential ownership within a company. So just to give you an example, a convertible note can be, I'm going to give you $100,000 as a loan, right? It's a loan. However, if you are unable to pay the loan, if we come to a different set of negotiated terms, if for any reason something goes sideways, this note is not paid, this loan is not paid within the agreement that we have, my $100,000 now converts to ownership or equity within the company, right? And I don't want you to look at this as particularly a bad thing. It's not a bad thing that somebody has part ownership in your company. It actually could be helpful, particularly if they have a certain level of expertise that they can provide for you in the business. But it is something that you need to understand how it works. Convertible notes really provide a significant advantage over other forms of financing because they allow companies to maintain control, maintain control without giving up large amounts of equity or ownership within the company. And finally, as we move into the ending this segment, there is the third type of capital, which is equity. Equity is ownership stake held by investors or shareholders in a company. It usually provides let me take a step back. Equity is ownership in a company, and that you are become an investor or a shareholder, and it usually provides a return for the shareholders over time. It also gives investors confidence in the long-term success of the company. Equity is a great way to attract outside investments and provide financial security for all stakeholders and the founder. Equity can also act as collateral for lenders, providing access to capital for the business that may need some funding. So here are some of the types of equity instruments that you may come across. There's what's called private equity. You hear a lot about private equity in the news, particularly now as it relates to the housing market. Private equity firms are buying up a lot of housing or real estate. Often you'll hear the abbreviation PE. When you hear a PE firm or a PE fund, they're talking about private equity. Private equity means that it is a private group of investors that have collected together a pool of money that is now going out and buying these investment opportunities. The next one is venture capital, or VC. You hear that a lot, especially as it relates to entrepreneurship and tech businesses. So VC, same sort of thing. It's a private group of individuals. It could be one individual, it could be more than one individual, or it could be a group of organizations, but that they have pooled their capital to make major purchases or major investments into a particular sector. Then there's public equity, and then there's angel investing, right? So angel investing is just what it sounds like. It's an angel who is putting in a relatively small amount of money compared to a private equity firm or a venture fund. It could be 100,000, it could be 50,000, it could be $200,000. Usually when you get to that $250,000 mark, that's when you start to see private equity come into play. But an angel investor is typically an individual, and they're going to be putting in, anywhere from 10 to maybe $100,000, possibly $200,000. Anything more than that, that's when you start to get into a private equity investment at around $250,000. So here are some things that you'll need to know about an equity investment. Equity is usually associated with tech companies. The number of investors that are actually interested in equity investments for non-tech businesses is significantly small. Also, you need to know a non-tech company typically needs about $1 million in sales and or strong realistic projections with a solid plan to get there for them to look attractive for an equity investment. And then the goal, you have to remember with the private equity investment, is typically to sell the company in 7 to 10 years so that the investors can make a multiple return on their investment. So you really want to think long and hard about whether or not you want to sell your company eventually. Maybe you are looking for it to be to be passed down to your family. But one, you got to have a realistic conversation, because maybe your family doesn't want the business, and so selling the business in 7 to 10 or 15 years might make the most sense. Well, that is when a private equity, you've got to have that in mind if you are going to look for private equity investment. But just know that all of these terms can be negotiated, and they're negotiated up front. It's all put on paper and you agree to them up front. You can also put in the contracts when you're negotiating if you would like to have terms where you can renegotiate the agreement. Those are all things that you can negotiate it, but you can even negotiate the levers to buy back the equity if that is something that the investor is willing to look at. So that's it for this. We've talked about the 3 different kinds of capital: cash, debt, and equity. We've talked about different examples of each one of those. We've talked about the various names for each one of those. We've also talked about where and how you access each one of those. As we go into the next segment, we're going to be talking about the actual process that you have to go through, particularly with debt and with equity, which is called due diligence. So catch us after break. Don't forget to subscribe and leave a review. And when we get back, I'm going to get into the whole entire process, the due diligence process, and all the dirty 30 of the questions that you need to be answered. Thank you for listening to Do Different Better, and I will catch you after the break. Hey, my money moguls, I am back. We are back at the Do Different Better show. I'm your host, Elaine Rasmussen, and we are here talking today about the different kinds of capital and how do you fund and fuel your business. In the first segment, we really talked about the 3 types of capital: cash, debt, and equity. We talked about what they are, how to access them, and what to be careful of. So the one thing that you're going to have to go through, particularly with debt and with equity, is you're going to have to go through what's called a due diligence process. So that is what we're going to get into now in this segment. So first of all, everybody who's going to go through getting any sort of capital for their business, and I would say any kind of personal capital, it doesn't really matter. You are going to have to go through what's called due diligence. And really, it's that opportunity for people to get to know who you are and make sure and verify you are who you say you are and you do what you say that you do, right? So think of it as dating, but with that friend who is also a private investigator on the side. Right? That's really what we're going to be talking about. So first, let's talk about the process. There is a process for getting ready for any capital investment. The process is usually called due diligence. And there are 3 parts to due diligence. First is what's called a screening due diligence. Then there is business due diligence. And then there is legal due diligence. Okay. So, how might you need to prepare for each one of these? And I'm going to go into them individually. So, first of all, what you want to think about is screening due diligence. Screening due diligence is really people watching you. You're not necessarily going to know that this is happening. One of the things when I've talked with businesses is they'll find the person will say, "Yeah, I've been following you on socials for a couple of years," or "I've seen you speak at a couple of things. And so when I saw you speak, I started following you." Or, "Yeah, I've been watching you in the news and seeing how your business has been growing." The screening due diligence process, you typically won't know that it's happening. It's when you get onto somebody's radar and now they're just like, kind of, watching you. Maybe they're watching your LinkedIn. Maybe they have set up a Google alert that every time your business is mentioned, they're going to get a notice in their inbox. But the screening due diligence is that they're watching you. So remember when your mom told you somebody's always watching, make sure you show up and show out. Like, this is kind of that thing. You really want to be mindful of how you present yourself, especially when it relates to your business. You want to always present yourself well because you never know who's watching. Now, once again, this is not meant to scare you. This is not meant for you to think that people are stalking you, but they kind of are. But this is also not meant for you to get analysis paralysis. It's just for you to be aware that people are interested in you and they want to make sure that you're consistent of who you are and how you represent yourself. Because once they start to invest in you, they're going to be working with you. And so people want to get in business with people that they like. So they want to know, do they like you? So just like anything else, if you were going into a new friend group, you always got that friend who maybe doesn't say necessarily too much at the beginning. And then once they get comfortable, they turn into a chatty Cathy. It's very similar, right? The next part of due diligence is what's called business due diligence. When you go into business due diligence, this is actually a demarcated moment in time where it is known with all the parties that the due diligence process has started. It could be as simple as you go to your bank and you're like, "Hey, I'm thinking about getting a business loan, or I'm thinking about getting a line of credit. What might I need to do?" And you start that conversation, and the banker might say to you, "Hey, well, send me your profit and loss statement for last year. I'm going to I'm going to send me your bank statements for the last 6 months. Let me start looking at your documents and see where you might be falling short. Let's see where you might be having challenges. Or here, let's talk about what you're doing well and what you might need to work on. And here's what we require." Right? So it's that formal process of like, you are interested in getting some kind of capital, whether it be investment capital, whether it be a loan, but you are formally entering the process of starting to share documents, whether it be on your end or on their end, that you are trading documents to know that you are entering in this process. This is when they start looking at your profit and loss statement. They'll start asking you maybe your income statement. They'll ask you for projections. They might ask you for what is your organizational budget. But this is the formal collection of documents to start the analysis of, one, do you qualify for a loan, or are you the type of investment that this investor would like to make? And they're going to use these objective analytical documents or financial documents to be able to make those decisions, right? There's what I call the dirty 30 checklist of questions. And I will, if you DM me, I will send you the dirty 30 question. These are 30 questions that anybody who's going to give you money in any kind of capacity will typically ask you, whether that, once again, that money is a debt or that money is an investment. They are going to ask you these questions in one form or another, maybe informally, or they might be formally, but they will ask you, these are the questions. I've been doing this for a very long time. These are the 30 questions you will always be asked, no matter who you are. I would even say, from a personal standpoint, if you're getting even a home loan, most of these questions are going to be questions that are going to be asked. The whole intention of the process is to make sure, one, you are able to live up to your end of the bargain, that you're not over promising and going to under deliver. Okay. Then we move into what's called the legal due diligence process. The legal due diligence process is really about, now we're going to ink the deal. So whether that is You can maybe think about closing, doing your closing, which is everything's going to be signed off on. This is where we're going to double check everything that was agreed to. Or if you're making an investment, this is when the accountants and the lawyers get involved. And if you are doing an investment opportunity, whether somebody's investing in you or you're going to invest into a business, you should have separate lawyers. You should have your lawyer and they should have their lawyer. You should have separate accountants. You should have your accountant and they have their accountant, because they are there. Those professionals are going to represent your interest, right? So they're going to keep your interest in mind. So when you are going through this process, you are going to have your accountants look through all these financial documents and the agreement. You're going to have your lawyer look at the agreement and make sure these are terms that you are agreeing to, that these are terms that are favorable to you, that these are terms that you can actually live with and deliver upon, right? So these are all the things. This is the actual process, and almost every single business will go through this process. If you decide to go for any sort of debt capital or investment capital, you will have to go through this process. So it's really important for you to get prepared. So how can you get prepared for this conversation? The first thing is to get all your financial documents in order. One of the things that I highly recommend is that you create whether it's a box account, a box.com account, whether it's a Google folder, but you should be keeping these documents regularly updated. What I love about, if you're using QuickBooks, you can actually have QuickBooks send you any of your financial statements on a regular basis. So for me, I have QuickBooks send me a PDF of my P&L every month. I have that P&L downloaded into a folder. So at any point in time, I am ready for somebody who asks me for my most recent P&L. I don't have to go look for it. I don't have to go research it. I don't have to fiddle around with QuickBooks, because QuickBooks is automatically sending it to me every month and annually every year. So I have all those documents ready. You really want to know what your cost of goods sold are, or what your customer acquisition cost is. We really think about customer acquisition when we talk about a tech company, but I think it's always good for any business to really understand how much does it cost you to acquire a customer, so that you're understanding what does that look like, and how much is it going to cost you when you lose a customer versus gaining a customer, right? Or keeping a customer versus losing a customer. You're going to want to have your business budget. And if you can, you want to kind of see where you're tracking month over month your expenses to what the budget was. So taking your whole budget, amortizing that out for the month, and then thinking about making sure that your accountant is helping you track month by month, how are you accumulating expenses and where your expenses are going up and down. But you want to have an organizational budget. You should be building that. I like to build my budget the last quarter of the year for the preceding year. And then I like to look at it in 6 months to see how did I do as far as budgeting goes, and versus how I spent, so that I can make any adjustments that I need to make in the final half of the year. You also want to have your projections. You want to have a set of projections that at least go maybe 2 to 3 years out. It's really hard, especially in this day and age, to look any further than 2 to 3 years out, because the world is just changing so quickly. So having projections like at least 2 years out, 3 years if you can. I wouldn't say 3 years is kind of industry standard, but industry standard is also changing because the world is changing so quickly. So as long as you have 2 years of projections, that's great. And projections are, what is the pace that you're going at, and what does that look like on an incremental increase, right, over the next couple of years, right? And understanding what's it going to take to meet those projections, whether it be equipment, whether it be human capacity, really being able to speak to that. And then you want your other organizational documents like trademarks, your partnership agreements, any contract, particularly if you have some larger municipal contracts or large enterprise contracts. You want to make sure you have those in a place, because your investor might ask to see those. Your banker might ask to see those if they're looking at possibly giving you financing or giving you an investment, right? So here are some things that you can do to prepare. Okay. So to prepare for this, you want to really think about getting your house in order, right? you really want to start practicing some good business practices. And this is getting ready for, once again, it's just good business. This isn't just even about, I'm looking for an investor or I'm looking to do some debt capital. It is really about, these are just good things for you to do no matter what, whether you're going to be looking for capital or not. So what I'm going to do is we're going to like wrap up this segment at this moment, and I'm going to really get into all the things that you can do to get ready to for financing and the due diligence process, right? So we're going to wrap up right now, and we're going to get that into the next segment. Thank you. You've been listening to Do Different Better. I'm your host, Elaine Rasmussen. If you haven't already, subscribe to the channel or let us know, what do you want to hear? If there's a particular subject or somebody you would like to interview, please let me know. And we will we'll make sure that we get that onto the docket. But don't forget to don't forget to share this episode with somebody that you think needs to get an investor. And I will see you after the break. Welcome back, my finance savvy folks. I'm so excited. We are getting into the last segment of thinking about and talking about the kinds of capital and how you can leverage them to fund and fuel your dreams in your business. So in the first segment, I really talked about how the three different types of capital. It's cash, there's debt, and there's equity. Every single kind of financial instrument that is under the sun is going to fit under one of those categories. And then in the second segment, we talked about the due diligence process, which is the process by which somebody is going to analyze whether or not they're going to give you and make an investment. Or if you are an investor, because I know all of you are on the come up, what must you be thinking about or doing, or what information do you need to make a sound investment into a business? So now that we're going to kind of getting into the home stretch here, what I'm going to be talking about now is some strategic decisions and pitfalls to avoid. I'm also going to tell you how to get prepared for this process and what are things that you can do. And I'm going to make some recommendations on some things that you can read or some resources that you can access. And now, if you're really good, I'm going to put something for you for just as a special prize. So first, let's start talking about what are the things that you can do to get ready for an investment. And once again, you've heard me say this 1,000 times. If you stay ready, you don't have to get ready. So this is really about thinking about being prepared from the very beginning and not necessarily waiting till you need money. I always tell founders, the best time to find money is when you don't need it. The worst time to go and look for money is when you actually need it, because it seems like you can never access it. You just keep getting doors slammed in your face. So the way to do that is start getting ready to get capital. Even though you may not be thinking about getting an investment, you're like, Elaine, I don't need an investor. I don't need a business loan. You never know. Because once again, as I mentioned, these are just really good practices. So making sure that your operational and financial structure is in place. So making sure that accessing files is really easy to get to, whether that is in paper, but I hope that you're digitizing them, because anything could happen. If we've learned anything with the wildfires that have happened across the country, things can just go up in flames. So digitizing and having things either on a backup and or in the cloud is just a really smart idea. And having those things organized. One of the things I drive my team crazy is really having filing and naming conventions for digital files. So it makes the file easy to find. I also like to require all that they're in the header or the footer of our documents. What's the name of the file? And because the name of the file is actually the name of where you find the file on our drive, it makes it really easy for anybody in the company to find any kind of file, no matter what. If they found a piece of paper on my desk, they will know exactly where to access that file. Now, they may not have access to it, but they know where the file is and they know where to find it, and they can then tell me, hey, I need access to this file, right? So just keeping things organized in a digital space, but also having them clearly named so that you can find what information you need very, very quickly and easily. It's going to be really having this structure is going to be the foundation of your business growth. It's just going to help you in the long run, but it also requires you to help you figure out what kind of capital that you actually need, and how you're going to use it and when you're going to get it. So these are really great practices. So it's going to be important as you think about, one, if you're going to be an investor, or two, if you're looking for an investment, is getting super clear about how much you're going to need, when are you going to need it, why you're going to need it, and what kind of capital is going to be ideal for that particular investment. One of the things that we do in our accelerators, we actually help people create what's called a capital plan. We have them take their projections and look at your projections, your 2 or 3 year projections. Based on those projections, what kind of things might be needed to be invested in the company to ensure that those projections are met. Maybe it's going to be buying a very expensive piece of equipment. I sit on the board of a social enterprise, a $40 million social enterprise, and we had to buy $100,000 piece of equipment, right? So, but we knew that by buying that equipment, it would actually triple our production. So, but we didn't need the equipment right away. We knew that in 8 months, that's when we were going to need the equipment. So it's now a good time for us to go and start looking for capital to be able to finance that piece of equipment that we're going to need in 8 months, that's going to triple our production in 3 months once we get it, which will then increase our revenue by 20%. So these are the things you want to be thinking about. And these are the questions that you're going to have to answer, and the type of response that you're going to need to have if you're going to engage in, whether it's a bank loan, a line of credit, or an investor. So I want you to kind of think about those kinds of things. The other thing that I want you to be really thinking about is when and why you should choose equity over debt, and how that goes back to that capital plan, right? So here's the thing that I think sometimes businesses don't really understand. You may have a bad relationship with debt. I know I grew up with like being told never owe anybody money. But the fact of the matter is businesses can't really grow without debt. So let's just take a real practical example of what this looks like. Let's say you're successful. We're going to presume that you're successful. So that means your sales are going up, which means your production is going up, which means you're hiring more people to get more work done. Maybe you need to hire more consultants. Maybe you need to hire more labor. As your production is going up, so are all of your expenses. And the amount of money that it's going to take, the gap between what you're taking in sales and what it costs you to produce, they're going to go like this. It's going to go up, up, up. And that gap is going to stay pretty regular. It's going to be hard to make a dent in that gap. So you cannot make enough cash in order to make the investments in the company that you actually need to make. Now, unless you've got like a 50% profit margin, which is amazing, if you're able to do that, kudos to you. But most businesses, particularly in the manufacturing space, if you make a product, as you make more, it costs you more, right? You've got to bring on more staff. You've got to buy more raw materials up front before you can actually make the product. The raw materials might be sitting in inventory. So you need a loan to go and buy that expensive piece of equipment, or to hire 5 more people that are going to increase your capacity, right? That's where you have to think about different kinds of expenses are more ideal for different kinds of capital. If you're looking for equipment, or if you're looking for human capacity, you need to hire more people. Really, a loan is the best way to do that, typically. Now, once again, I'm going to be speaking in broad strokes, but typically, if you're needing to buy more equipment, or you need to expand, the number of people that work for you, or you need contractors, getting a loan or a line of credit is ideal. But let's say you need to get a building, right? Then that might be something that's more ideal for finding an investor, right? Because then what you can do if you're looking to buy a building is the building is going to be a separate piece that's from the business. And you can find an investor that's going to co-invest in you to go and buy this piece of real estate while keeping the business separate. So once again, I just want you to iterate that different kinds of expenses are ideal for different kinds of capital. And maybe I'll do something on the YouTube channel that kind of goes into this a little bit more for each one of those things. But you really got to have an understanding, and you're going to get that understanding by understanding your projections, how your projections are built, but also looking at your cash flow and how much money is coming in, and at what is the frequency or the pace or the scale that the capital comes in. So, Now I really want to get into what are some of the pitfalls or cautions, right? Some of the common mistakes really around, particularly with lines of credit and other kinds of debt. One is overusing your credit cards. I think I've talked about on the show. I pay for almost everything with my credit card, but that's because then I'm keeping my cash, but then I pay the credit card off at the end of the month, and I'm accruing points, which I then use to travel for personal use. Right. So thinking about how all of these things, all three of these capital types weave together, whether for you as an individual or for your business, really thinking about, you want to be careful of overusing your credit card or using your credit card debt for something that's maybe not the best ideal situation. What you don't want to do is buy a piece of equipment that costs $100,000 on a credit card, right? Because when you think about 30% interest, that is a good way for your company to go under in a very short period of time, as opposed to going to a bank, getting a loan where you're paying 6% interest. Paying 6% interest monthly is far more manageable than paying 30%. But I understand sometimes you get into a situation and you're just stuck in a situation, but I just want to bring up the point of like the difference of those things, right? The other thing is undervaluing equity, right? So what's really great about equity is that it shows up on your profit and loss statement as an asset versus debt shows up as a liability. And what that means is if somebody's looking at your financial documents, whether it's an investor or a banker, if you've got more in the liability column than in the asset column, that's what's called over leverage, and you are what's called a bad risk, and they will not lend you money. So that's where an instrument like a convertible note comes into play, where you can like, hey, a convertible note may, as it converts to equity, makes your books look better because you have more equity or assets on your books than you have liability. And that is the goal. You want more assets assets are money coming in, right? Or ways that you can access money. Remember, I talked about liability is money going out the door or people you owe money to. So you always want to look like you have more money coming in or that you have access to than what you owe, right? And that's just a good life philosophy, right? The other thing is really having realistic projections that have clear repayment and exit strategies. As part of our integrated capital fund, when we work with a founder, we actually redo their projections based on the amount of money that we're going to invest so that they have clear line of sight of these are the implications if we invested 75,000 versus 100,000 versus 150,000. And then the small business owner that we're making the investment in gets to choose and has confidence that they're able to pay that back because we've actually shown them what it looks like based on the sales projections and the financial implications to their bottom line based on how much they intend to receive as an investment. So as we're kind of winding down, I want to give you some resources. I want you to walk away with some really great resources. If you go to the Connect Up Institute, www.connectup.org, connectupmn.org, there's some resources there that can help you understand some of these relationships between money. They've got a great accelerator called the Capital Readiness Accelerator. If you're thinking about, if you're not even sure, but you just want to start getting your business in order, just in case you might need financing, they've got a great 12-week accelerator. There's also some great books out there. There's Venture Deals by Brad Feld, and it's really great about understanding equity and convertible notes. There's also Profit First. I've got several of my small businesses that really use that cash flow management system. It's a little overcomplicated to me and it's a lot of work, but if you're really bad with money, it's a really great tool to start exercising that muscle of getting better about managing money. But so check it out. There's also there's lots of great other folks that are out there. I'm going to be hosting some conversations that are focused on women. So check that out. And actually, we're going to be launching my affiliate group of Next Femme Financial. So there's lots of resources out there. There's some really great books out there that really can help you talk through and think through and understand how might you want to think about whether it's your personal, how am I leveraging debt and how might I leverage a line of credit. And there's also great information about if you're looking to have to be able to do this from a business perspective. So I'm going to wrap up this episode. Thank you so much for listening. You're listening to the Do Different Better show. I'm your host, Elaine Rasmussen. I can't wait to see you. Don't forget to subscribe and don't forget to watch us on YouTube at do.different.better. See you next time. Sorry about that. I was looking for a message on the chat.